Hey, have you ever noticed something kind of infuriating about gas prices? When there's some kind of crisis in the news, a pipeline issue, tension in the Middle East, a hurricane that hasn't even hit land yet, gas prices jump 20 cents overnight, sometimes more. Almost like someone's got a hand on a lever just waiting for an excuse. But then, when oil prices actually crash, when the crisis passes and crude drops back down, those prices at the pump crawl back down, slowly, over weeks, sometimes months. And everyone's got someone to blame, right? It's the president, it's inflation, it's the economy. But here's the thing, those answers are lazy. The truth is a lot more calculated and a lot more deliberate, because what's happening at that gas station sign isn't random, it's a system. And today, we're going to pull that system apart, piece by piece. We're going to explain something called the rocket and feather effect, why oil companies are choosing not to produce more oil even when they're swimming in profits, and how a concept called capital discipline is keeping your tank empty and their pockets very, very full. Let's get into it. The rocket and feather effect. Economists actually have a name for what you've been feeling at the pump your whole life. They call it the rocket and feather effect. Here's how it works. When crude oil prices go up, say there's a supply shock or geopolitical tension spikes, gas stations raise their prices almost immediately, fast, like a rocket. They'll justify it by saying they need to protect their margins on future inventory they haven't even bought yet. But when crude oil prices drop, prices at the pump come down like a feather, slowly, lazily, drifting down over weeks while the station quietly pockets the difference. Now you might be wondering, why don't gas stations just lower prices faster to attract more customers? Wouldn't that be good for business? And here's where it gets interesting. They know you're already used to the high price. You adapted, you grumbled about it, maybe carpooled for a week, but eventually you just paid it. So if they drop prices too fast, you might start actually shopping around again, comparing stations, becoming price conscious. That's the last thing they want. By keeping the drop slow, they capture what economists call extra profit during the lag period. You're paying yesterday's high price for today's cheaper oil. That gap? Pure margin. And it happens every single time there's a price drop in crude. Studies have consistently shown this pattern across gas markets in the US, Canada, the UK. It's not a coincidence. It's a feature, not a bug. So the next time you see oil prices drop on the news, but your gas station hasn't moved, now you know exactly why. The myth of just drill more. Okay, so now let's talk about the argument you've probably heard 100 times, usually from a politician standing in front of an American flag. Just drill more, open up more land, produce more oil and prices will fall. It sounds logical, right? More supply, lower prices. Economics 101. Except, oil companies don't want to do that. And they've been very open about why. After years of overproduction in the 2010s, when companies drilled aggressively, flooded the market, and then watched oil prices collapse in 2015 and again in 2020, the industry learned a brutal lesson. Producing more doesn't always mean making more money. Sometimes it means destroying the very price that makes your product profitable. So they adopted a philosophy called capital discipline. Capital discipline basically means this. Instead of reinvesting record profits into new wells, new refineries, and new infrastructure, companies like ExxonMobil and Chevron are using that money to buy back their own stock and pay out bigger dividends to shareholders. Think about that for a second. These companies made historic profits, tens of billions of dollars, and chose to hand that money directly to investors rather than increase production. Why? Because Wall Street rewards them for it. Investors don't want oil companies to drill more and crash the price. They want returns, they want buybacks, they want dividends, and when oil companies deliver that, their stock prices go up. The result is that supply stays tight, intentionally, Because in this industry, a manufactured shortage is more profitable than a surplus. A shortage means high prices. High prices mean fat margins. Fat margins mean happy shareholders. So when politicians tell you to just drill more, the oil companies are sitting there quietly saying, "Yeah, we're good, thanks." The refinery bottleneck. Now here's the part most people don't even think about. And it's actually one of the most important pieces of this whole puzzle. Crude oil isn't what goes in your car. You can't just pump it straight from the ground into your tank. It has to be refined, processed into gasoline, diesel, jet fuel. And that process happens in refineries. So here's a fact that should genuinely shock you. No new major oil refinery has been built in the United States since the 1970s. Not one. In over 50 years, the refineries we have today are aging, heavily maintained, and running at near 100% capacity. There's almost no slack in the system, and that creates an incredibly fragile situation. Because if even one major refinery goes down for maintenance, or an unexpected outage, or a storm, it creates a localized shortage almost immediately. And what happens when supply drops suddenly? Prices spike, and spike hard. Here's the thing though, the oil industry knows this. They understand that the refinery bottleneck is a structural ceiling that keeps prices elevated regardless of what happens with crude oil supply. And conveniently, every time a refinery goes down for scheduled maintenance, it doubles as a perfect excuse to raise prices and point at capacity constraints rather than corporate decisions. Building new refineries would cost billions and take years. It would also add capacity that, frankly, oil companies don't want, because more refining capacity could eventually push gasoline prices down. And we've already established that's not really the goal here. So, we're stuck. Dependent on infrastructure that's half a century old, with no real plan to expand it. And every hiccup in that system costs you at the pump. The invisible hand of OPEC+. Okay, we've talked about what's happening domestically, but there's a bigger player operating above all of this, one that can override almost everything we've discussed with a single meeting. Meet OPEC+. If you want a simple way to understand what OPEC+ is, think of them as the central bank of oil. Just like a central bank controls the money supply to manage inflation, OPEC+ controls the oil supply to manage price. The group includes Saudi Arabia, Russia, the UAE, and about a dozen other major oil-producing nations. Together, they control a massive chunk of the world's oil supply. And they meet regularly to decide, collectively, how much oil the world gets. When they want prices higher, they cut production. Millions of barrels per day, just switched off. They call it stabilizing the market. But what they really mean is keeping prices at a level that funds their national budgets. Saudi Arabia, for example, needs oil above a certain price per barrel just to balance its government spending. So when prices dip below that threshold, they cut. Coordinated, deliberate, effective. And here's the part that makes domestic drilling arguments even weaker than they already sound. Even if the United States dramatically increases its own production, OPEC+ can simply cut their output by the same amount to keep the global price floor exactly where they want it. The US drills more. OPEC+ produces less. Net result, global supply stays the same, prices stay the same. You pay the same at the pump. It's a ceiling and a floor, operating simultaneously, built by a cartel of nations whose entire economic survival depends on oil staying expensive. So let's bring it all together. Why don't gas prices ever really go down and stay down? It's not one thing. It's a system with multiple reinforcing layers. There's the rocket and feather effect. Psychological pricing that captures extra profit every time the market dips. There's capital discipline, oil companies deliberately choosing shareholder returns over new supply. There's the refinery bottleneck, decades-old infrastructure that creates fragility and built-in excuses for price spikes. And there's OPEC+, a global cartel with the power to offset any domestic production gains and keep the floor high. Each layer feeds into the next, and together they create a system that is remarkably good at one thing: keeping prices elevated and profits maximized regardless of what the market is actually doing. So the next time you're standing at the pump watching those numbers spin and you feel that familiar frustration, just remember, the price isn't high by accident. It's high by design. Thanks for watching. If this one opened your eyes a little, share it with someone who always wonders why they're paying so much to fill up. And we'll see you in the next one.